Hi, I am Ryan Jinks, and I am in Georgia. I had to think about that for a minute. I just spent 62 hours in a cave, about a mile into it, and we were doing some exploration stuff, and I wanted to film a how not to invest video. All those videos will be on the How Not to Highline channel, but it's just really awful to film in a cave. So this porch is prettier than the way that cave was. So I want to talk today about risk. The user ClimbSki Repeat left a comment asking for me to talk about risk. And I think that's kind of a really great topic and really ties in the two channels, especially in how to manage risks. Because if you take zero risks, that's risky. You can't go forward without taking any risks. Just waking up, brushing your teeth, and getting in a car to go to work technically is a risk. So I'm going to talk about how I manage risk for myself, and then maybe we can get some comments on here and we'll readdress the issue if we get some more examples. I tend to be, ironically, a safe-ish person. I typically like to have 5 or 10 to 1 safety ratios, so I'm only putting on 1/10 the force of my gear. And investing, I like to have my stuff kind of like spread out over enough stuff and diversified to where it's safe-ish, and that is going to get me average returns at best. So that's a real downside in order to technically grow wealth. Now, investing in an ETF or an exchange traded fund is kind of like a mutual fund. In an index fund, which is like, say, the S&P 500, basically the run-of-the-mill way of investing in kind of the biggest 500 companies. That is real basic. You're diversified as long as the stocks don't all drop 30%, which they might here soon, and we'll talk about that. Then you're safe. Like the S&P 500 is never going to go to zero. If it goes to zero, like we all died from COVID-21, so you're pretty safe. But if you throw all your money in Tesla and for something happens to them, yeah, it's a little bit more risky. I don't see Tesla going to zero. But if you throw all your money in Dogecoin, I don't necessarily see that going to zero, but that is what we'll call very risky, especially if you throw it in some of these other kind of shit coins that are just now taking off and you're hoping people bite onto them. So for myself personally, I did not like stocks because I got into them in the year 2000, right as the dot-com bubble started. And then I bought my condo, my first house, in 2005 when I was 21, like a responsible young man, at the top of the housing crisis, at the beginning of it. So I kind of got soured on real estate at the same time. So I kind of like pulled back, because like if you got hurt climbing, you'd probably not go climbing for at least a little while. And I kind of stayed out of stocks for a long time. I pulled all my money in 2005 out of stocks. I was like, screw this. Threw it in my house. And my house basically I lost like 70%, and I ended up having a short sell, which is a really crappy feeling because I have an 800 credit score and I'm responsible and I pay my bills, but my $153,000 condo went to literally $50,000. And banks came out just fine. Over what I paid over the years and what they got back, they did just fine. But yeah, it was kind of a really crappy feeling. And so I've really felt what I'd call failure in having my money go nowhere for 5 to 6 years in the stock market, and then lose everything I've put into my first house, which is like, generally pretty excited about your first house. So fast forward to 2014, I have saved let's say about 150 grand at that point, because I painted houses, I work hard, lots of hours, lots of good business things that we can cover on how to do good business on this channel. If you'd like, leave comments below on what you want to see, because that really does steer what I'm going to talk about next. I do try to not sound too YouTubey on here. I think a lot about a topic, but I try to go unscripted because I want to just share more of my personal experiences and eventually other people's if they are willing to share them. But I saved about 150 grand and in 2014 I got some private loan money at 3.5%, which is pretty good for what we'll call a commercial loan or a loan to buy rental property. And I was going to try to buy something bigger, and I ended up buying a duplex and a house. And I was still renting at this time, so I rented out the duplex and the house. I did not move into the house because I didn't need more space than I had, and that was a 3-bedroom, 2-bath. So I rented those out for a little bit. The duplex is where I put my money. The house is, I did basically 100% financing, which is like, ugh. But that's where risk comes in, because if the house drops, then I'm kind of screwed. And if it goes up in value, then great. But I also had like equity on this side, so I kind of just treat them as one lump sum. Fast forward 2 years, I move into the house, and I gained, let's say, about $6,000 from renting that house out over the rent I was paying over here. So it was a net positive at the end. At the end of the day, I could have just probably moved into it and been just fine. But I do like to live with the largest expenses, such as like a house and a car, as minimal as I can, so I can splurge on the stuff I do like. So I eventually moved into the house, and I'd love to cover that in a video sometime about home ownership, because I do not own that house anymore, or the duplex. Now, if I took that 150 grand in 2014 and put it in the stock market, I would have, well, by now I would have tripled my money, but I doubled my money on the duplex. That's only because real estate has gone quite high. The rents basically just covered the cost. And I felt like that was, let's call that a safe investment, because the house isn't gonna go to zero. There's insurance if it burnt down. And you technically have a tenant paying for the bills plus that much more. So eventually, because the tenants are paying off that mortgage and that principal payment is giving you equity, and then you're hoping the property goes up in value. It's a lot of work for very little reward, but it's lower risk. And so my family was in real estate, and so that felt more natural to me because I can touch it and I can work hard on it. But at the end of the day, I'd rather go, well, I don't know about caving. I'd rather go slackline. I'd rather go climbing and kind of live life. It's just not, I don't have 2 kids, a dog, and a house to maintain, so I'm not in town a lot. And so I decided to get rid of the duplex, and I am now putting that money into the stock market, which is scary, because right now I feel like the stocks are pretty high. It seems a little silly to invest in a chart of all the stocks when it looks like half of a mountain, because if anything we've learned over the years is things do eventually come back down, and it does this. So when it's like at the very, very top, so being skittish about that, I pulled my money out. I was smart and put some, not a lot, but a decent amount back in March and April and May, when things were really down because of the pandemic, and things had gone up 50%. In November, I sold most of it because I'm like, oh, I'm happy with what I have, and I don't want the risk anymore. So I literally have been sitting on cash since November, and the stock market has gone up like, let's say 20%. To February, I'm like, oh my gosh, I missed out on so much money because I wasn't willing to take the risk. It's not like I would have sold the stocks if they went down. It's something that I'm gonna hang on to for a very, very long time. And I was trying to time the market, which clearly never works out for me. So I'll explain to you what I've decided to do with my portfolio and how to manage my emotional risk, because a lot of what we end up doing is based on our personality and our ability to hang on when it gets hard. Because if we're gonna get skittish when it gets difficult, if you're gonna get scared when you're 2,000 feet up El Cap, you don't wanna go up El Cap, because you could die if you don't know how to operate under pressure. So can you maintain the investment strategy you choose when shit hits the fan? Really, technically, that's what it comes down to. So I have to know myself in order to pick my next investments. So let's tie crypto into this for a minute. Crypto seems pretty scary. I was investing very little bit, like 200 bucks a month, back last January. So that was great. Everything went cheap around March and April, and then everything just shot up since. And then when things shot back up to when Bitcoin went up to 20,000, because I was buying in the 8, 9, 10, 11, 12,000 range, I'm like, oh, I'm gonna sell it. And then when it crashes back down to 10, I'll buy it. And now it's at, it was at 60. Now it's at 44. And I'm tempted to buy more of it. So being that I just keep missing timing the market, I am not just going to go ETF in the S&P 500 like the VOO, the Vanguard S&P 500 index. It's a super low fee, run-of-the-mill, safe investment for being in equities or stocks. Safe, at least it used to be, would be like bonds or CDs. But even bonds can go down in value if you buy a 1% bond and then things go up to 3%. Nobody wants your 1% bond anymore. So I don't feel good about bonds. Plus, there's risk there and not enough reward. And so you have to decide how much risk and reward. Now, that's stocks, crypto. Back to crypto. Bitcoin is the most adopted at this point, and Ethereum. And so I chose 10% of my portfolio and I put it in Bitcoin and Ethereum in this last January, the one we just had, and I made money. Bitcoin's gone down, so I haven't doubled that yet, but Ethereum, I've doubled my money, and that has been great. There's so much reward, it's worth the risk, but I've only put 10% of my portfolio into it. So can't help it but bring a highline analogy into this. We build our anchors for our highlines with multiple points of contact to the rock or whatever we're attaching. So I'm not going to have everything in crypto, even though I technically really like it. I don't really want everything in stocks because they sometimes suck. And I definitely don't want 100% of all my stuff in real estate again because, well, then I missed out on the stock growth that just happened. So I don't want to be over diversified because then I don't specialize or understand all of my investments. I got to keep it to a minimum so I can keep tabs on it, but not watch it so much that I freak out every time it goes up or down. Because I've made more mistakes when things have gone up recently than things have gone down. Now I am anticipating things dropping quite a bit. And so how do I manage that risk? Because that's a real risk. It's basically, people call this the stupidest bubble in history because it seems really obvious. But there are people who are convinced we're not in a bubble. And so I don't know who's right. And it would be terrible if inflation, and I don't think Venezuela inflation is going to happen, but if inflation happens, I don't own a house any longer. I don't own a duplex. And so if I own nothing and everything goes up, I am able to buy less with my money, and then I lose the growth. And I'd love to talk about covered calls in another video where you can make consistent income if stocks are trading sideways, and how it's not working out for me because when things go up, sometimes they go up very quickly, and that's what we've been noticing, and then you buy in after that, and then they go down. Anyways, so there's a lot of conflict in my head on what kind of risk there is, what kind of risk I personally can manage, and you really should only invest in things that you're supposedly an expert on. And since I'm not really an expert on anything other than painting houses, which I'm trying to do less of, I am going to do 50% of my portfolio in the stock market and crypto and real estate, like my whole portfolio. I'm going to go 50% in, let's say, the next 6 to 9 months. And I'm going to kind of dollar cost average huge chunks into it. So I'm 50% in. So then I can just focus on the 50% I get right, whether or not it all drops. I still have 50% to drop back into the now cheaper stuff. And if it all goes up, I'm like, oh, at least I bought 50% of it. And so 50% is kind of my rule right now, where I am buying 50% of the VOO, the S&P 500. And 50% goes into specific things that I have high conviction in. And some of those could be more Bitcoin, as it's gone down a little bit, or even Dogecoin, which I don't think is going to be around forever, but it's also a really fun one to play with. if I'm playing with a higher risk thing like Dogecoin, I'm only putting, I think, $600 into it. I can lose $600, but in theory, it could go up to 10 grand, who knows? And some of these new coins that are coming out, especially before they get on like Coinbase or Gemini, before they're easy to buy, my theory is if you stick $1,000 in these hard to get coins, when they do go on these major brokerages, then you naturally it's going to double because more people flood the market. Do you hang on to it forever? Because the only regret I've ever heard of about Bitcoin holders is the fact that they sold too soon. So in 10 years, what is Cardano going to be at? And when 10 years, what is Omi coin going to be at? And I'm on Helium coin, but I'm only putting very, very small amounts in, and it's more of an interest to me than the S&P 500. Like, it's kind of boring. You stick it in and you know it's going to eventually go up eventually. So dollar cost averaging is a great way to manage risk. Now I still bring in a little bit of income, but it's not enough really technically to save. So I'm in kind of a unique position where I have this big chunk I'm supposed to do something with, so I can kind of have a half-assed retirement, and hopefully like either YouTube or the TV show we just did turns out. But most people who are still working, I think dollar cost averaging is just the absolute best way to manage risk. And you take that, let's say you have $500 at the end of the month, and you want to put that into basically your future retirement. You can throw some into REITs, and we have video on REITs versus syndications versus rental property. So you're in real estate. Like that's one of my better stocks happening right now, because I bought it cheaper because people were scared if the tenants were gonna not pay the rent, and that was risky, buying a stock like that, or a REIT. REIT is a stock that has real estate holdings in it. But you can buy a little piece of real estate that way. You can buy the S&P 500, or you can just buy Tesla because you think they're really freaking cool. And you can just diversify all of it pretty easily into M1 Finance. I have a tendency to just touch my stuff too much to use M1 Finance yet personally. But that is an option to set it and forget it, kind of make your own little mutual fund. It's really not that hard to choose 3 stocks you like and 2 index funds and 3 real estate things. And you can do 20%, 40%, and then you should have a little bit in crypto. I 100% believe that crypto is going to be something in 10 years, like substantially, and it's worth being in. None of this is financial advice. This is just how I'm managing my portfolio. I am working with a friend who is investing their money with a professional, and half their money they are managing themselves. And in kind of the basic spread out diversification dollar cost average that we're talking about here. And we're gonna see, because it's like 50-50, I love 50-50, and we're gonna see if professionally managed minus a 1% fee, or if just doing yourself and getting average with almost no fees does better. We will see, and we will definitely make a video about that. A lot of the how not to invest videos that'll come up are going to be us kind of either shit testing financial advice you hear on YouTube, or just testing these theories of putting $1,000 in 30 different shit coins to see if the wins outdo the losses. So I love the topic of finance. I love talking to you guys about finance. I nerd out about numbers and dollars and bad advice on the internet more than I nerd out on climbing gear. It's risky to have no risk in your life. The best parts about life are the things you risked to get there. So we can talk about my painting business and kind of the ways that I made that successful enough to be where I'm at today. But I definitely enjoy telling stories. I enjoy testing things that so many people want to see. A lot of end users don't understand their gear. A lot of people trying to manage their finances with a lot of noise from the internet. YouTube seems to be very hype focused. Also try to make thumbnails that make you want to click on the video. But at the end of the day, the more noise you make or the more dramatic you are, the more views it gets. And the algorithm is gonna promote those videos. So please like and subscribe to this channel. This is gonna be a little bit more of a mellow channel. And we really kind of want to bring a little bit more common sense, a little more level-headed investing. It's not that hard to preserve your wealth if you manage your finances well. We can talk about basic finance management. Spend less than you make. Try to make more money through side hustles. Invest the difference you have. Invest something every month. Try to get out of debt, especially the bad kind is what I mean. And starting businesses is definitely the way to make the most money if you're built for it. If you're not built to run your own business, it's not going to make you more money. Money is also not everything. I am living on less personally, so I can do more adventures because that's what I love. What is the point of getting to financial freedom if you're not going to do anything with it? So I think that's maybe a real focus on this channel, is the why you want to be financially free. And not just because you don't want to be stressed about money. I'm just as stressed about money, and I've got enough to supposedly retire if I don't screw up this portfolio I have. So I feel like it's just as risky as the 400-foot dome I rappelled yesterday. But you understand your gear, or you understand how the mechanics of the diversification works, and that's how you manage risk. You have to manage your emotions, because you're the #1 risk in managing your finances. I cannot believe I've talked for over 20 minutes about this. I'll see you in the next video. I try to post these whenever I can squeeze out time and wherever I end up being, and it's always in a different place. Maybe the next one will be Moab. See you next time. Cheers.